Okay.
Right.
Hello, Jim. Nice to have you with us today. This is Tiffany from Gate Ventures. I'm the investment associate here at Gate Ventures, handling investments and also partnerships. So today we are back with another episode of Gate Ventures podcast, the RWA stack. And we are just about the right time to be bringing on the right guest, Jim from Superstate, when DTCC literally announced their trial run for tokenizing stocks literally a few hours ago. Hello, Jim. How are you?
Doing well, Tiffany. Not just today, but there's just so much going on in the space. So it's great to be joined with you and to go through all the exciting developments in crypto and RWAs.
This is exactly the hottest sector that has been discussing throughout the whole crypto cycle these few years. Before we dive in, I think it would be great to also kind of go down your background a bit, because you actually have a very interesting background that is bridging TradFi and DeFi together. So you got a CFA and traditional finance background, but you entered DeFi actually quite early, which is quite rare for traditional finance. So what did you see back then that brought you into crypto and DeFi?
Yeah, it's funny. My parents, I just spent 2 weeks with them and we were kind of recounting the decision that I made to bring my career into crypto full time, and was quite contrarian at the time and maybe made them disappointed for a short period of time until they saw all the great things that we've been up to in this space for the last few years. But honestly, I started out at the banks doing really, really boring stuff in the back office and was motivated to go off and do fun, interesting frontier technology in the financial space. And that is exactly the definition of DeFi. During DeFi summer, I was not at Compound yet at the time, but was certainly an enthusiast of everything that was going on in the space. Robert Leshner created DeFi really from scratch, and everybody was glued to their screens, getting involved in yield farming and kind of understanding the principles of what the technology could eventually be was fascinating for me personally. And so I said, instead of being an observer from the sidelines, why don't I reach out to Compound and see how I can get involved in a full-time capacity. So luckily, when I first joined, it was starting to bring the institutional capital into the markets. And because I have a collar and was, wearing a suit, it was the right time for me to go represent the technology into large banks and asset managers. And we built a business called Compound Treasury at the time that was a couple $100 million from institutional investors that were trying to get yield from the protocol, but didn't want to touch it directly themselves. And so it was a great experience to help teach people what was going on in DeFi, but also help them keep an arm's length distance away from participating in it, which now is matured quite a bit, where folks like the largest banks on the planet are actually getting their hands dirty into DeFi quite actively. So things have changed over the last 5 years, but I've always been interested in the convergence of technology and capital markets, and DeFi, certainly was right in the middle of that bullseye. So had to take my talents to do that full time.
That's actually very interesting, because people didn't really start talking about institution money getting into DeFi until like last year, or until after Bitcoin ETF, but you started off bringing them into crypto quite early. So how would you describe the history of institution adoption in crypto and DeFi?
Yeah, there's been a lot of fits and starts, at least historically. Maybe some pilot programs or some exploratory diligence. And then there was, of course, the cycles definitely tracked institutional interest, but that mold has been broken over the last cycle, where despite the bear market we're in right now, which I don't think anybody's saying that out loud, but let's call it what it is, at least when it comes to a lot of the tokens and the projects that were built during the last cycle, there's a lot of less activity than there was before. But that's completely different than what you're seeing on the institutional side. And I think you're right. The fact that BlackRock and a number of firms came in with an ETF and really spent a lot of time educating investors about what allocating to this asset class would look like was a great catalyst. But I actually would go back even further and say that the stablecoin space really started to wake a lot of people up to what is possible to bring finance on chain. And if I go back to the Compound Treasury example, we actually got a credit rating from S&P, which is the largest rating agency on the planet, because we sold a debt instrument and the debt was funded by yield from the protocol. And every institution that we talked to, the first conversation we had with them wasn't what is Compound or how are you getting the yield? It was, okay, you're taking my money and then you're turning it into a stable coin. What is Circle? What is USDC? And it really started fundamentally on that conversation. Now that is table stakes. And that was only a short period of time ago. That was 2021. So, in 5 years, folks have said, okay, I know what a digital dollar is. And now they know what a blockchain is. And smart contracts and protocols are now like the next I guess, element of the capital markets that everybody's starting to figure out. But the major inflection point, I think, was even through FTX in the last few years, institutions have continued to progress their mindset in whether it's experimentation or actual bringing products on chain. That momentum didn't die when the bear market hit. It's continued to progress. I mean, we're in the middle today, Superstate, of a number of RFPs from the largest banks on the planet to help support launching products in 2026. And I think they're catching up to the products that have already been built, which, Invesco took over one of our products. I'm sure we'll get into more about Superstate. But Invesco runs $2.3 trillion in assets under management, and they are actively managing a fund that Superstate has created. So there are live, real examples of material capital being driven towards institutional asset managers and banks. And so if you're not participating actively in this ecosystem, you're being left behind, which that FOMO is real for those that are catching up to those that are more active. But in prior cycles, nobody was active. So the FOMO was not real because you didn't look around at your peers and your competitors if you're a big bank and say, oh, somebody else is participating. So there's been a material inflection point. Now we're at this additional inflection point, at least in the US. Once Genius went through, there was a lot of activity and building around stable coins. And, of course, the payment spaces continue to grow and DeFi continues to grow. Tokenization continues to grow. But Clarity Act in the US, I think, is a big unlock for institutions to get even more comfort participating in these markets. And that hopefully comes through this year, which brings another catalyst to the bull market to keep the momentum going in the direction that it's at, but at a steeper slope is my anticipation.
You have great insight in institutional adoption. So that reminds me of an article that A16Z published 3 days ago. Institutions only want blockchain. They don't want DeFi. Do you agree with that? Or what are institutions looking for?
Yeah, so I think institutions want programmable finance. They don't want DeFi. I mean, the whole concept of DeFi is getting rid of intermediaries. And it's contrary to the business model of a lot of institutions, which are by definition intermediaries. And I think there are certain applications and services and products that can be built using decentralized principles, but an entirely decentralized, permissionless environment is certainly not a world that a regulated institution wants to live in. So I do agree with A16Z by and large, but I do think that there's a lot of applications and technology that's been built like a decentralized protocol. So if you look at Aave, I think if you fuse the world of Superstate and Aave together, you get Aave Horizon. And that's their RWA market, which is using the technology for borrowing and lending assets in a permissionless manner. But the underlying assets and the participants in that market are known to regulators, known to institutions. They're KYC'd, there's verified identities associated with those participants. And you get the benefit of 24/7 markets, instant settlement, programmable interactions between market participants. But you also underneath the hood know that they are institutions, that they are hedge funds, banks, or whoever that are participating. It's not, non-KYC'd wallet or participants. So I think the rails were demonstrated through DeFi Summer and a lot of the permissionless activity that's permeated through blockchains. But I think our thesis has been, and especially given our seat at Compound, is like, the ceiling is only like 1 meter high for DeFi when everybody is permissionless and, the capital that's available in those markets is largely a small subset of the total addressable market of finance. In order for the protocols that have been developed to expand to a larger addressable market, it needs real world assets. Not every institution is going to be holding a long tail meme coin as a long-term investment as part of their portfolio. But if you look at a DEX, which has proven capital formation or has proven secondary markets or certain experiences that are not possible in the traditional market, when you extend that technology and apply it towards traditional securities, whether it's treasuries, stocks, bonds, ETFs, that's the world that we've envisioned. That's why we left Compound and started Superstate, is that the 1 meter high ceiling of DeFi in the traditional or the legacy world of crypto will never have escape velocity to reach the hundreds of trillions of dollars that are in traditional capital markets unless you build the right regulatory apparatus so that institutions and traditional market players, whether it's hedge funds or family offices or wealth management businesses or private banks or individuals like ourselves, you need high quality, legitimate assets that have real regulatory rigor underneath them, applied to the DeFi protocols and systems and blockchains and stablecoins that are out there, so that you can then bring that 1 meter ceiling up to a lot higher.
So when it comes to the idea of RWA, since all these banks are talking about RWA, but the underlying idea is tokenization. However, there are a lot of ways to tokenize something, and people just categorize them as RWA. So what do you think tokenization is, and whether there are any misconceptions you're seeing from the crypto market and crypto folks about tokenization?
Yeah, it's a great point. So tokenization is a broad category. RWAs even is a subset of tokenization, right? Like NFTs obviously is a form of tokenization, but it's just a different asset class. But when you think about like real world assets or securities tokenization, there are a few different flavors and categories. Broadly speaking, I bring it into 3 different buckets. The first bucket are wrapped tokens. And by the way, my large disclaimer before I describe all of this is I actually think that there's utility and use cases and investors or people that want each one of these categories for different reasons. So they're not mutually exclusive, and they're also not necessarily better than the other. It just depends on who you are. And, the size will depend on what the demand is for each of these categories. So I just throw that as a massive disclaimer. But the wrap tokens is basically setting up a product that holds the underlying security in a balance sheet of a custodian, let's say an SPV or a broker dealer or some other type of structure that keeps that entirely off chain and doesn't actually work directly with whoever's issuing that asset, right? So like when you have a stock, a company issues their stock, they do that directly to investors so that they can raise capital from them, and they give them ownership rights in that company. When you have a wrapped version, you're basically somebody else is holding that on your behalf. Now, what that opens up is distribution to international markets. Like I'm talking from a US perspective. So it opens up international markets that may or may not have the ability to hold those stocks directly in a brokerage account or open up, some sort of access to the US capital markets directly. And so the token provides exposure to that asset, but you don't actually directly own it. So when Tiffany holds a wrapped Tesla stock on chain, you're getting exposure to the price performance of that Tesla stock, but you don't actually sit on the cap table, right? You're in the venture business. When you're investing in a company, you are likely directly on the cap table as Gate Ventures, but in the wrapped world, you're holding it through an SPV, let's say, or there's some sort of a derivative or a CFD that's giving you exposure to that without directly holding it. Now, again, that's actually been very popular in crypto these days because of the access point that I made and just the lack of need to work with each individual issuer. Is like you can actually expand into hundreds of stocks or hundreds of bonds if you're just wrapping it from a custodial perspective. So that's one thing, but you have a counterparty that sits in between you and the actual underlying. The second is the DTCC. You actually mentioned that earlier today. And DTCC, at least in the US, is basically the 8,000 pound gorilla. Like usually you say 800 pound gorilla. Like they are the bedrock of all of the US capital markets. And it's primarily because blockchains didn't exist when they were created. And it's effectively a large vault that holds the securities, and there's entitlements to those securities through a network of broker dealers and clearing firms. I like to think about like the Wi-Fi symbol. Everybody's on their Mac and like looking at that symbol. DTCC is like the bottom circle of that whole layer cake of market participants. And what they've built is basically tokenization that enables the markets, the participants that are directly on top of DTCC, like broker dealers or clearing agencies, to use tokens to better interact with each other. So repo activity, settlements, collateral mobility. there's value there. But you or I, as Jim and Tiffany, can't participate in that token directly because we don't have an account at DTCC. The third model is Superstate's model and Securities and a number of others, Figure and so on, that are natively working with issuers to natively tokenize stocks, natively tokenize funds. And so when you actually hold a token issued through Superstate, you own a piece of the cap table. You're an LP on the cap table. You have ownership rights directly in a particular security, and you are then more in control of that asset than you are through the other models. There's nobody in between. There's no broker dealer. There's no SPV. Like, you literally own that stock. And so when it comes to the ethos of crypto, of self-custody and the ability to move your assets in a way that allows you to interact with capital markets that doesn't require somebody to tell you can do things or you can't do things, the native tokenization model allows you to have that control. And it opens up the surface area for issuers to do a whole lot more with their investors because they know who you are. They can more directly interact with you. They know full transparency of who their investors are at any given moment. They can airdrop you stock because they've seen that you've held it for like 6 months. So maybe they give you an airdrop. Like, all the things that are great about crypto, that can be built programmably on top of these assets from an issuer perspective that now get to control the investor experience directly. What Superstate does is that latter category, working directly with issuers to bring their shares on chain or their funds on chain. It removes a lot of the intermediaries that I described, like that Wi-Fi symbol no longer has like 4 or 5 different rings to it. It's literally just you and the company, which is a more direct relationship. And that opens up more capital markets opportunities for you as an investor to use your assets in a way that we all know and love by holding tokens and crypto, but now applying that to the securities where it's not possible to do that in the traditional system.
Yeah. So could you also kind of share with the audiences, how do you maintain this legality and how has it been structured? And for issuers that came to you guys, what are they looking for and expecting to do with their tokenized shares issued through Superstate?
Yeah, it's a great question. So Superstate runs a digital transfer agent, and the transfer agent is a technical term in the US meaning basically responsible for recording ownership. So whenever a company issues stock or an asset manager launches a fund, whether it's a mutual fund or an ETF or a private fund, they have a cap table of all their investors. And so Superstate runs that cap table technology, but leveraging the blockchain. And so what Superstate has built is Tiffany wants to invest in a particular asset. She comes to Superstate, onboards, we know who she is, and have a number of wallets, whether they're your MetaMask, your Phantom, or your Anchorage, like, we're agnostic to all of that. We want you to be able to get your assets wherever you want to hold them. But we've associated your identity with that wallet address off-chain. So I know that 0x123 is Tiffany and 0xABC is Jim. The license that we have, the transfer agent license, reads the blockchain so that we can keep track of the ownership in real time. And so if Tiffany moves her shares into Aave to borrow stablecoins, like, we track all of that activity and enable the issuer to be compliant with the US regulatory requirements of maintaining a full auditable database of their shareholders and investors at any given moment. Traditional transfer agents do that in a much less sophisticated manner with a lot of spreadsheets and humans that keep track of that information. We do it through reading the blockchain, and that opens up a lot of opportunity, which I'm sure we'll get into. But why did issuers come to us in the first place? Maybe Galaxy is a good example. They're a $10 billion market cap company, very successful business, already public, listed on the NASDAQ, tons of investors. But they see an opportunity not only because they are a crypto native company, but because they're very forward looking in terms of just broad capital markets. And what they see is the opportunity to open up access to invest in their stock to investors that don't have a brokerage account. So access is one major benefit for a company to go on the blockchain because, as we all know, anybody with an internet connection and a wallet can participate in the network. And so that's the beauty of blockchains. You don't have to ask for permission to be able to tap into a protocol or to invest in a token. The only gating item on our side is just KYC, which is not everybody's cup of tea, for sure, but it's a regulatory requirement. And that's why institutions like Superstate, because we do enforce that. But access is number one. Number two is utility. So the investors that want to do more with their assets, which is everybody on chain today and increasingly the largest institutions on the planet on behalf of all of their customers, They want to be able to use their assets as collateral in a market to borrow stablecoins and maybe buy more of the asset. So we're all familiar with looping. We're also familiar with cross margin. And so being able to take your assets with your own control and lend them out and earn the yield entirely. Or use them as collateral to do certain activities without, again, asking permission. So that utility is extremely important. The third thing I'd say would be investor engagement and transparency. So we had touched upon it a little bit there. Galaxy now knows that Jim Hiltner is a shareholder and has 5,000 of shares with Galaxy, and I've been holding it for 10 years, let's say. Like that is valuable information if you're the company and wanting to know who your loyal shareholders are. And you just don't have that transparency in the traditional markets, because if you go back to that Wi-Fi symbol example, the company sits at the top of that stack and there's a ton of intermediaries in between, and they actually don't know who the end investor is without asking for a lot of spreadsheets and information on like a quarterly basis. But you open up Superstate as Galaxy and you can see all the shareholders in real time, which just opens up engagement opportunities that is just not possible in the traditional markets. So think about loyalty. Like I fly Delta. I get a lot of airline miles because I'm a traveling salesperson, so I fly quite a bit. But imagine I had a tokenized stock and they knew that not only was I this investor that held, the stock for a certain period of time, but I also traveled and this is my travel patterns. Like maybe they can airdrop me a certain experience. So there's investor engagement opportunities that's available. And just like efficiency that comes associated with a lot of corporate actions, dividend payments. There's a lot of mouths to feed in the issuer world that you have to pay service providers when you want to pay a dividend or you want to do a vote. When you have on-chain programmable experiences, a lot of that expenses goes away. So it makes it actually cheaper for you to raise capital in the crypto markets. And then the last thing I'll mention is just stablecoin compatibility. I use this example all the time, but like imagine companies decided not to build a website and take money over the internet to sell goods. Commerce was a major platform shift for brick and mortar and retailers to be able to reach customers all over the world that wanted to buy their clothes or whatever it is. That's the same thing that's happening in stablecoins. And that's why Stripe is getting into stablecoins. It's why PayPal is in stablecoins. It's why like MasterCard and Visa are in stablecoins, because payments are going on chain. The same thing is happening with asset managers. Like Invesco partnered with Superstate because they realized that, hey, there's 300 billion of stablecoins. There's going to be trillions of dollars of stablecoins. And if their job as an asset manager is to raise capital, that's a large amount of assets that they would not otherwise be able to tap into unless they had a tokenized fund that was on chain, able to take subscriptions and dollars from investors in stablecoins. And you would be ignoring a large, growing demographic of investors if you were not tokenizing your assets to raise capital from them. So, the platform shift of moving money from paper to the internet to blockchains means the issuers in the capital markets want to be in that platform as well so that they're able to interact with investors that are in the system.
So among all kinds of institutions out there, what kind of institutions would be benefiting the most from Superstate's opening bell product?
Yeah, on the opening bell side, it's really issuer driven to get started. So when a company goes in IPOs, which is an area that we're focused on quite a bit at Superstate, they are raising capital through investors that have an account with that investment bank, which is a lot of investors. Don't get me wrong. Like SpaceX raised $75 billion, $80 billion in its IPO. Like that's a lot of money that they raised, biggest IPO all time. It's dwarfed all of the IPOs from last year. In terms of like even total aggregate from 2025. So there's a lot of investors that have a JP Morgan, a Goldman Sachs, whatever it is account. But there's actually a lot of investors that have a Gate account, that have a MetaMask wallet. What we're doing is helping issuers when they go out and raise capital as an institutional client of Superstate, maximizing the demand for a particular offering by including that incremental sleeve of investors that otherwise can't participate in the deal. So we launched the money market fund USTB, and we have investors around the globe that otherwise Invesco would not have been able to service. And there's $1 billion in that fund today. That fund will be substantially larger in the future as more and more investors come into these types of products. That is our customer first and foremost, is the issuer, making sure that they're able to reach investors in all of the four kind of like reasons that I just described earlier, but that's like the number one case. The number two case is coming around to folks like Gate and Onchain businesses that are large, that have a lot of volume, that have a lot of users. And because of the bear market that we're in, I think these firms have realized that the assets that are available, similar to our aha moment at Compound 3 years ago, the assets that are available on chain are not the long-term assets necessarily that will build sustainable businesses for the future. And so altcoins, meme coins, yeah, there's a speculative demand cycles here and there. And like, of course, that will always be inherent in crypto and the investor base that participates in these markets. But when it comes to long-term sustainable businesses with high quality assets in the traditional markets, tokenization is bringing those types of products into platforms like Gate. And so that is another cohort of clients from an institutional standpoint are the distribution on chain where there's a ton of investor activity and demand, but the assets that are available in those platforms are not necessarily the ones those investors are holding in their brokerage accounts off platform. So we want to complement the existing product suite by bringing in funds, by bringing in stocks, in fixed income, you name it, all of those types of assets. So that way Gate maintains the relationship and grows the wallet share that it has with its clients to be able to diversify their portfolio on the platform as a super app, right? The future is not 75 different logins. It's all under one platform, and tokenization is bringing the assets into those platforms to get access to the traditional capital markets. So I think those are probably the biggest ones. When it comes to the large banks and the traditional institutions, so when you say institution, I think everybody thinks like Citibank or Morgan Stanley. Honestly, those are our clients as well too. They are looking at how do they create products to similarly create new experiences for their clients and create more efficiencies in their business so that they're able to serve their clients better. Stripe buying Bridge, I think, was a big awakening moment for institutions. Why did they do this? Stripe already serves basically every merchant on the planet, which then touches basically every credit card network and every bank. Their technology is fantastic. However, it's not the cheapest to operate. And when you think about stablecoins and the efficiency that comes in to play there, it's a margin game as well too for Stripe to say, hey, can we improve the operations of our business where the front end experience to the client might not change? They're still swiping their credit card or making a transaction. That transaction just happens to settle underneath the hood into stablecoin rails, which is more efficient, more programmable, more 24/7 without needing to pay a bunch of intermediaries to settle a transaction between the seller of a good and a buyer of a good. I think the same thing is true in finance, where the origination of an asset, the distribution of that asset, the secondary market activity of that asset has a lot of paperwork and spreadsheets and archaic systems that make that happen, whether it's settling a stock or it's investing in a fund or it's paying a dividend. And tokenization allows that to be managed more programmatically and more efficiently. And I think that is partly why the large institutions that I mentioned that are looking at this very seriously, because it improves the profitability of their businesses while also increasing the total addressable market.
So one thing I think is very key is that as we see more money getting into stablecoins and being on chain, institutions like Invesco, they are seeing there's a huge amount of money sitting there. So it could be also attractive to companies that want to do IPOs, right? Would you envision a future which companies would be completely doing their IPO on chain? And how far are we from that?
It's a great question. To my point earlier about how crypto activity has proven what the future of capital markets could look like, we take a lot of inspiration from that. So my first thing that comes to mind is Pump.Fun. Probably everybody that's listening into this has participated in some meme coin launch at some point in time, especially middle of last year. What you recognize there is, number one, there's a ton of capital that's available. Number two, the ability to reach that capital is possible from a peer-to-peer perspective. Like there wasn't an investment bank involved in any meme coin launch, right? It's an issuer or creator built a brand, a business, then met investors all around the globe through a platform that was facilitated by smart contracts and stablecoins. So if you expand that and take away the meme coin side of it and put in company XYZ that has a filing with the SEC, absolutely, I think that's where the future heads. What I don't envision, because I'm maybe like too much of a pragmatist, but I don't envision that happening fully on chain tomorrow. And while there's 300 billion of stablecoins, like if SpaceX IPO'd on chain entirely, the liquidity of the secondary markets isn't quite there yet for that stock to trade as much as it does on the NASDAQ today, right? Like I think it's 200 billion of volume on the NASDAQ every single day, and probably spiked even more when SpaceX went public. That just the amount of capital that's already accessed through the traditional system onto that exchange, for example, means the liquidity is really hard to compete with until the markets on chain start to mature. And like you're seeing NASDAQ, you're seeing NYSE and others that are looking to build on-chain systems. That's the lifeblood of capital markets. And so while issuance is possible to raise $1 billion from a bunch of investors, that's of course possible. But the investors that are investing aren't just doing it to be able to stake their assets for a very long time. Some investors have a 10-year investment objective. Some investors have a 10-day investment objective. And there's some investors that want to buy it on the secondary market to see how it performs after the IPO. So that liquidity really matters in terms of just general capital markets. And I think crypto will get there. But what we envision at Superstate is that the initial proof points of capital formation on chain will come from two different areas. On the IPO side, we're working with some of the largest investment banks on the planet to bring issuers to market that will carve out a sleeve of their IPO to on-chain investors so that they're able to reach that demand. But it's not in the entire thing. Whether it's like 5%, 10%, 2% remains to be seen. And that's where the expertise, I think, from the investment banking perspective actually is quite helpful. But that'll be the first proof point is on an IPO, is giving people access to invest a company where at the price that everybody else does in the institutional world. That's certainly an area that we think is really ripe for disruption and opportunity. And it's incremental bid to an IPO, not necessarily cannibalistic. So if a company was going to raise $1 billion, maybe they can raise 1.1 or 1.2 or 1.5 by tapping into the crypto capital markets. The second area is really around follow-ons and secondary offerings. We run something called the Direct Issuance Program. We will launch our first one very soon, which is allowing a already publicly traded company to raise more capital. And so if you're familiar with the concept of an ATM, MicroStrategy is probably the most famous one in crypto. Bitmine does it, SharpLink does it, and others that basically use what's called a shelf registration. So after already being public, you can file a shelf with the SEC and you can raise equity capital from investors at the market price. That's what ATM stands for. It's at the market. And so we envision the same thing being possible through us as the transfer agent to investors that are on chain in tokenized form. So instead of going to your broker dealer and saying, I want to buy more stock, and then they're buying it from the company, it's done through the traditional markets. Instead, investors can buy those shares directly from the company without needing an intermediary. And again, that's where smart contracts and stablecoins come in. But both of those areas are parts of the traditional capital markets that have been built over many years that we think is going to come on chain very soon.
So I think one key thing that you mentioned is that tokenization gives composability and accessibility to users and to companies that are looking for more liquidity. So as we mentioned, like DTCC is working on a lot of initiatives around this area, and they are also trying to push DTCC's clearing to get to 24 hours, 5 days a week, while Superstate's infrastructure and blockchain and tokenization technology, it technically allows 24/7 trading possible and settlement. However, we haven't seen a venue that's actually hosting live 24/7 trading for non-wrapped tokenized stocks. Is that because of a capability, or is it because the reality it doesn't have a need over there?
It's actually a regulatory barrier. So despite how much has been improved in the US from a regulatory perspective, there's still certain aspects of the capital markets that aren't quite compatible with blockchains yet. And secondary markets is a very interesting area. Liquidity is the lifeblood of capital markets. And there are no venues today for the natively issued tokens to trade like they do in crypto. There's two different market structures in DeFi or DEXs. One is called an RFQ, like request for quote. We actually did the first pilot with a security Galaxy GLXY. If you go to Jupiter Z and you type in GLXY or just Jupiter, you'll actually see trades that we did with Wintermute as the market maker late last year, just to prove the concept that you could actually bring real security on chain and you could have a market structure that allows people to trade. We will be scaling that up again, but it allowed peer-to-peer trading for whitelisted individuals to go to the protocol and buy or sell GLXY. So very much possible, but it's one stock, it's one market maker. It was like $1 million of proof of concept in terms of inventory. So not at the scale of what Galaxy trades today in the traditional markets. So pales in comparison, but it's possible and it's going to scale at some point. The other market structure is AMMs, so automated market makers, Uniswaps and the Orcas and the Radiums of the world that are all very well equipped to trade at high volume and allow people to participate as their own LPs without needing to have a winner mute necessarily on the other side of a trade. It's not available for US securities to trade from a regulatory perspective today. The SEC is working on, and they've been very public about this, an innovation exemption. We anticipate it to enable. Everybody will see when the final wording comes out. Some experimentation of these types of stocks in AMMs and allowing the protocols, the wallets, and the market participants to really start to build up liquidity in those types of venues, which honestly trade a lot more than the RFQ markets do today. So wrappers aren't available to people in the US. They're not technically a US security. They're offered offshore. So there's less regulatory barriers for those products. But for the ones that are natively issued out of the US, there are certain limitations from a secondary market standpoint, and that will definitely be brought down at some point in time. It's just a matter of getting that, the Clarity Act through, but also getting more guidance from the SEC on what's permitted. The good news is that Superstate's already built all the connectivity to the venues that I just mentioned. And so as soon as that's permitted, you'll see a lot of activity day zero.
We also have a lot of users that are quite young at Gate. So for a lot of Gen Zs and crypto natives, it's very difficult for them to understand why things are not 24/7 because everything's automated. It's great that you mentioned the collaboration with Galaxy, and now Galaxy can be used as collateral on Camino, right? I believe composability is not just a plus to these share issuers. It's also a plus to these stock traders. If they are thinking about a long-term strategy, hold the stock for a bit longer, composability in DeFi is actually very attractive to them. So in terms of DeFi composability built around Superstate, what's something that you're seeing that's missing, and what's something that excites you the most?
So the example that you highlighted is absolutely correct. So if you go to Camino, you'll see a Superstate market. It actually has Galaxy Forward FWDI, which is the largest Solana DAT, as well as USCC and USTB, which are the two funds that we initially launched. Now Invesco and Bitwise have taken those over to be used as collateral to borrow stablecoins, which is a very useful product for, to your point, investors that want to be able to get leverage or liquidity against the assets that they're holding for a long time, and be able to control their activity versus asking a broker to do that for them. The same thing exists in Aave Horizon, which is their RWA market. We were one of the first assets in that market. At our peak, I think there was 300 or 400 million of Superstate assets in that market. 2 of the 5 assets are Superstates that are as collateral there, and really helped scale that market quite a bit because our investors like the utility of being able to borrow against their shares. Morpho, very similar, build markets there. So all the lending markets, I think we've gotten the collateral use case down, and we've actually demonstrated that to the SEC to show how it all works. And so from a regulatory perspective, complete comfort around that. What's missing from a collateral perspective or from a lending ecosystem perspective is being able to lend your asset out and have somebody else borrow it. So today, the collateral that I had just described in those 3 venues is just sitting there as an idle. It's not rehypothecated. So you can't lend out your Galaxy. You can't lend out your USCC or USTB. You can borrow against it and park it there as an isolated collateral. And that's a good thing for now, but I think a big opportunity is securities lending, and is a very large revenue driver for institutions and intermediaries in traditional markets where you hold your Apple stock at a broker. They might lend that out to a hedge fund who's borrowing it at like 60% APY, and the broker's not paying you any of that yield, but they're lending your asset out. I want to participate in the economics, but I also want to control who the borrower is on the other side. That's my own personal take. Maybe my parents disagree and don't want that type of functionality. But I think the Gen Z audience that you're talking certainly is going to want that control to be able to hold Galaxy for 20 years, because I'm super bullish on Galaxy. But I'd rather earn income on it and lend it out for the next 10 years than let somebody else lend my assets out and earn those fees on my assets. So securities lending just does not exist in DeFi today. Aave is really focused on that. They've been very public about it. We're excited to partner with them to help pioneer what securities lending on chain could look like. It is a massive revenue driver for brokers, for ETF issuers, for a lot of institutions in the traditional markets. And we want to bring the power back to the people to be able to do that. But that type of activity just does not exist in the crypto markets today. You can lend your stable coins against securities, but you can't lend your securities out. And I think that will be a massive tailwind to native tokenization, because then people are going to wake up and they're going to look at their Robinhood and they're going to say, oh gosh, I have $10,000 of Apple that's sitting here and it's idle. So why did people move their cash into stablecoins? Is because they could take idle cash and they could lend it out on compound and they could earn 8% on somebody else who's borrowing that. So I think the same thing will happen with traditional securities when people have that optionality to move their assets from a traditional system where they get nothing and bring it into a system where they get everything.
Yeah, securities lending is definitely a very lucrative revenue source. When we look at some of the biggest broker dealers or even clearing houses, securities lending or stock loan could make up to half of their revenue stream
Exactly.
in their balance sheet. So it's actually very interesting to see that you're pushing this forward, and we are excited to see more builders building around this area. And if you're building something like this, reach out to me. We are doing
Me
this
too.
RWA stack. Yeah, this is definitely something very interesting. I have been looking into this sector for a while and trying to find something that could work. You mentioned that there's a lot of idle money sitting on chain, right? Which is why Invesco and Bitwise are reaching out to you to see how they can tap into this market. So when a name like Invesco decides to work with you and possibly connecting or integrating with DeFi, how did that happen? Because it's actually very difficult to move a traditional finance institution.
Yeah, I think honestly, it kind of goes back to my experience in the traditional market. I've always been on like very large enterprise institutional finance type of client exposure and whatnot. One of the business I ran was called Visible Alpha, and BlackRock and Invesco and Fidelity and Franklin Templeton and T. Rowe Price, like they were all clients of mine back then. So I know how they operate. There's a lot of due diligence and there's a lot of committees and working groups and all that stuff that goes along with it. And I think some folks and builders in crypto want to see quick wins. And certainly a deal like that was not a quick win. It was a long-term relationship. We kind of looked around the landscape of how do we graduate this product that we built, which was our baby. I mean, like we launched USTB. I think the first like check that came in was like $10,000 and brought it up to over $1 billion with some of the largest investors in crypto as our clients. So very much wanted to make sure it found the right home with the right partner that wasn't just a transaction for one particular product, but was a strategic relationship. And so we ran an RFP and we had like a number of managers that came and bidded for it. And Invesco, we knew quite a bit heading into that process. And they just demonstrated a lot of proficiency in understanding the market and also a lot of appetite to really get deeper into the digital asset ecosystem. We had worked with Galaxy, coincidentally, as their Bitcoin ETF and Sol and ETH ETFs. So like that franchise has already gotten comfortable with digital asset players. And tokenization was an area that they had a cold start problem. They were like, how do we get into this market and build a franchise and not have to build all the technology from scratch? And so we had done all of that. It was a happy home. And the goal from the onset wasn't just to have this USTB graduate and transition with Invesco. It was, what are all the other things that Invesco does across their franchise that we could do together? And so we're working through the partnership to expand into a bunch of other types of products that will help grow both of our businesses quite tremendously. What it's opened up, and we've rebranded that product to FundOS, which is a fund operating system, allows large managers to use the technology that we built to launch de novo funds or to take existing products and bring them on chain. Given the fact that Invesco did extremely rigorous due diligence, I think it's helped Superstate from a industry perspective to say, you know what, these guys are legit. And so Coinbase Asset Management was the first external fund that we launched at Superstate, Cushy, their stablecoin yield fund, which wouldn't have happened if they didn't look and see the process that they knew Invesco brought us through. So we're really excited. I can't disclose names, but multi-trillion-dollar asset managers will be coming down the pipeline in addition to Invesco, launching on Superstate in the not too distant future. Very exciting products in the second half of 2026. So it's opened up the floodgates for quite a bit for us and for Invesco. And Invesco, full disclosure, took a strategic investment in Superstate in our Series B as well too. So fantastic partners, and we're excited to build a future with them.
I'm really happy to hear so much great news from Superstate. And to follow up on that, what would success look like for Superstate in the next few years' terms?
I think on the asset management side, we're right at this inflection point of winning a lot of big mandates and expanding our relationship with issuers. We are at like 1.3 billion in AUM right now on our platform. We're sub 5 billion by the end of this year. I'd be surprised, just given the types of products that are coming on chain and the demand that we see in terms of our investor base. There's 300 different institutional investors that are all clients at Superstate. And so we've won big mandates from some of the largest protocols out there. And so I think the fund business will have a number of the largest issuers out there with a tremendous amount of AUM on that platform. On the opening bell side, I would say capital formation is a big focus of ours, and partnering with centralized exchanges and DeFi protocols for that liquidity problem that we described to bring more liquidity on chain for natively issued tokenized assets, which will then create more of the flywheel, similar to how our Fund OS business has grown. Getting a couple of green shoots out with issuers on the stock side of things, I think will help demonstrate to the broader capital markets in the US equities space that, tokenization is real. And if you're not just a crypto company like Galaxy or some of the others that are publicly traded that are crypto native, I think you'll start to see some AI companies and some other types of issuers that are looking to tap into differentiated demand channels and give their investors a better experience. And it won't just be a crypto native issuer game for the foreseeable future.
And following up on this, because as Superstate becomes more successful, that means there will be more financial institutions also tokenizing their products or issue their shares on chain, right? And that gives them the access to programmability. So would any of the middlemen or intermediary that we see in traditional finance be replaced by smart contract programmability or become unnecessary because of this?
I certainly think that's a board level conversation for a lot of firms out there right now that are trying to think about the competitive threats. It's so early to tell exactly, and I don't want to take direct shots at folks that I'm short right now, but there are a lot of middlemen that exist in capital markets that certainly we have already replaced in some of the products that we've built and will increasingly do so for the products that we bring to market. But these things take time. And I think the folks that are realizing that there's a threat to their existing business model are actively engaging to figure out a way to defend that turf. DTCC is a prime example of the tokenization pilot that came out today. I think that's fantastic because there's a lot that the DTCC can build and do with their gargantuan reach into the capital markets. It's actually a major tailwind to all the innovators that are trying to build around the ecosystem, and it brings more attention and capital and focus on what really is possible in crypto. And so those that are completely ignoring this and that are short crypto or short DeFi or short smart contracts or short stablecoins, they will very likely find themselves in the next 3 to 5 years without a job. And I think, every large institution that we deal with has certainly recognized that. And we're excited to partner with them and help them grow their businesses.
I definitely think this is something that kind of triggers some of the financial institutions and force them to start running again. Otherwise, financial institutions, they are specifically authorized by the government to do such business, and they have a barrier over there because of the licenses they have. And now they have to do in more things on innovation, which I believe a lot of new generations are looking forward to that. So I think as we are approaching the very end of the conversation, the final question is, as more stocks and funds are issued on chain via Superstate, from a user level, from a retail level, what new trading or investment opportunities could emerge from this?
Yeah, it's a great question. I think first off, it's staying in the ecosystem. It's like the super app model, right? It's cross collateralization. It's having all of your assets in one place to manage your portfolio. The innovation that's available, I don't think think people really understand like how interconnected your balance is going to be, your assets are going to be from a stocks, funds, ETFs, prediction markets, stable coins, meme coins. The landscape is quite broad. So I think having 24/7 markets is going to be tremendous. Real-time dividends is actually going to be really cool. Like you can earn a dividend in crypto for 8 seconds versus having to hold it specifically at midnight on July 15th so that you get today's dividend and then it goes ex dividend tomorrow and then drops by the amount. It's like just wonky stuff that like shouldn't exist. But I think the biggest thing that will change is access to products that don't currently meet the investors that want to invest in those products. So IPOs is a big thing. I think if Circle went public on chain, it would be a totally different story. They're a wildly successful outcome in their IPO, but it traded up an insane amount for the first few weeks because there were so many people that just didn't get into the deal from day one. And so I think IPOs has always been a soft spot for me in terms of seeing how many people get access to that deal and how many people don't get access to those deals. So I think access to directly invest into products that you want to invest in, being able to diversify into the greatest managers on the planet that you don't currently have access to, and being able to use those products across the ecosystem and earn the yield that you deserve for your own balance sheet is, what tokenization unlocks. The next couple of years is going to be an extremely exciting time for just capital markets.
Yeah, I think that's definitely very interesting. I have so much faith in Superstate, and I hope all the audiences here are like me. Please follow Superstate on Twitter. Please follow Jim on Twitter. I think there are a lot of alphas that could be announcing in the next few months, could create the whole trading landscape in this market. And thank you, Jim, for joining us today. Really, thank you. Do you have any last words you would like to speak to our audiences?
Yeah, well, thank you for the opportunity. This has been a fantastic conversation. I'm sure this the first of many, as we're both longtime builders in the space. If any of what I said resonated from an issuer perspective, from an investor perspective, from a builder perspective, like don't hesitate to reach out. We're always open to great ideas. We don't have all of them in our heads. We would love to hear from anybody that's thinking, how can we partner together to enhance your business or to enhance your portfolio? But there's a lot of really cool things coming out of Superstate. So I agree. Stay tuned on what we're up to and very excited to work with everybody here. And we're definitely, as you could tell, very much bringing the US internationally. I'll be out in Token 2049 and trying to spend a lot of time out in the region. And so free to stop by and say hello. I'm 2 meters tall, so you can't miss me. I'll be floating around over the next few weeks out in Asia, and I'm excited to see what's going on in the space out there.
Yay! Thank you so much. And if you are building anything related to this topic, feel free to reach out to me. Gate Ventures is still deploying, and we are very excited to support great builders for the long term. Thank you, everyone. Have a nice one.